Imagine waking up one morning and discovering that owning just a tiny fraction of a Bitcoin has become something only a handful of people on Earth can still afford. Not one Bitcoin, not even half a Bitcoin, just a few thousandths of one coin. At first it sounds ridiculous. After all, how could such a small digital asset ever represent life-changing wealth? That's exactly what millions of people said years ago when Bitcoin traded below $1,000. They laughed when it crossed 10,000. They called it a bubble at 50,000. And today, many are still convinced they're already too late. But what if they're asking the wrong question? What if the real opportunity isn't owning an entire Bitcoin anymore? What if the future belongs to those who simply own enough before almost nobody else can? Meet Daniel, a 35-year-old software engineer from Chicago. He's financially responsible, earns a decent income, invests in index funds, contributes to his retirement account every month, and has always believed that buying a full Bitcoin was the goal. Since he couldn't afford one, he convinced himself there was no point in buying a fraction. After all, what difference could 0.01 or 0.05 Bitcoin possibly make? Then one evening, while reading reports about institutional investors quietly accumulating Bitcoin, he stumbled across a question that completely changed the way he thought about wealth. Not, how high can Bitcoin's price go? But, how many people will actually be able to own a meaningful amount of Bitcoin once the supply starts disappearing? That single question sent him down a rabbit hole that completely transformed his investment strategy. Because while most people obsess over tomorrow's Bitcoin price, the wealthiest investors on Earth seem to be focusing on something entirely different. They're watching the available supply, and those are two very different games. Today's video isn't another prediction claiming Bitcoin will reach $1 million. It isn't another collection of flashy headlines designed to create hype. Instead, we're going to walk through three increasingly realistic simulations that reveal something far more important: how little Bitcoin someone may actually need in a future where billionaires, corporations, pension funds, ETFs, and even governments compete for an asset that can never exceed 21 million coins. If these simulations prove even partially correct, millions of people waiting for the perfect time could eventually discover that their biggest mistake wasn't buying too early, it was waiting too long. Before we dive in, I want to ask you something. If you had to choose today, would you rather own one expensive stock worth thousands of dollars, or a tiny amount of Bitcoin that could become nearly impossible to acquire over the next decade? Drop your answer in the comments, because by the end of this video, you might completely change your mind. Welcome back. If you're interested in understanding where money, technology, and the future of wealth are really heading, you're in the right place. Now let's uncover what almost nobody is paying attention to. One of the biggest myths surrounding Bitcoin has survived for years, and surprisingly, millions of intelligent people still believe it. If I can't afford one whole Bitcoin, it's already too late. It sounds logical. After all, nobody gets excited about owning 0.01 of a house or 0.02 of a company. So why would owning a fraction of a Bitcoin ever matter? Because Bitcoin doesn't follow the rules of traditional assets. Think about New York City. Imagine someone buying a tiny piece of land in Manhattan more than 200 years ago. Back then, people probably thought the purchase was insignificant. There was plenty of land available. Nobody imagined what Manhattan would eventually become. Fast forward to today. That tiny piece of land could be worth millions, not because the land changed, but because demand exploded while supply remained permanently limited. Bitcoin works under a similar principle. The total supply will never exceed 21 million coins. Not 22 million, not 25 million, exactly 21 million. Every new investor, every institution, every corporation, every sovereign wealth fund, and every government that decides to accumulate Bitcoin must compete for that same fixed supply. Here's where most people make a critical mistake. They assume every Bitcoin will always be available for purchase. But reality tells a completely different story. Millions of Bitcoin have already been permanently lost. Countless long-term holders have refused to sell despite multiple market crashes. Large institutions continue removing coins from exchanges, while many investors now view Bitcoin as a multi-decade asset rather than something to trade every week. Daniel used to think Bitcoin's future depended only on price. Now he realized something far more important. Price is simply the consequence. Scarcity is the cause. Once that clicked, he stopped asking whether Bitcoin could become more expensive. Instead, he started asking how many coins would actually remain available once institutional demand accelerated. And that's the exact question we're about to answer. Because if available supply keeps shrinking while demand keeps growing, the conversation changes completely. The question is no longer, can I still afford one Bitcoin? The real question becomes, how much Bitcoin will actually be enough? Now that we've uncovered why scarcity matters more than price, it's time to explore the three simulations that completely change the way we think about Bitcoin ownership. These aren't price predictions, they're supply simulations. Instead of asking how expensive Bitcoin might become, we're asking a far more important question. How many people will actually be able to own a meaningful amount of Bitcoin if the available supply keeps shrinking? Let's begin with the most conservative scenario. The first thing you need to understand is that not every Bitcoin is actively available for sale. Even today, millions of coins haven't moved in years. Some are believed to be permanently lost. Others belong to long-term investors who have repeatedly ignored market crashes and all-time highs because they have no intention of selling. But let's stay conservative. Imagine that roughly 16 million Bitcoin remain effectively available over the coming decades. That sounds like an enormous number. 16 million coins. Surely that's enough for everyone, right? Not even close. There are more than 8 billion people on Earth. There are tens of millions of millionaires. Hundreds of millions of people invest in stocks. Thousands of institutions manage trillions of dollars. Suddenly, 16 million doesn't seem so large anymore. Now picture a giant stadium with 80,000 seats. Only the first 80,000 people through the gate receive a ticket. Everyone else waits outside. Bitcoin works in a surprisingly similar way. Once enough people have accumulated their share, everyone arriving later must compete for what's left. In this first simulation, owning roughly 6% of one Bitcoin, around 0.06 BTC, could eventually place someone among an incredibly exclusive group of holders if supply becomes increasingly concentrated. Notice what this means. We're not talking about becoming wealthy overnight. We're talking about owning an asset that very few people may ever be able to acquire in meaningful amounts. Daniel couldn't stop thinking about this. For years, he believed that anything less than one Bitcoin was insignificant. Now he realized he'd been measuring Bitcoin the wrong way. He wasn't competing against today's investors. He was competing against tomorrow's demand. That simple shift completely changed his perspective. Instead of chasing one full Bitcoin immediately, he focused on steadily increasing the fraction he already owned. Because fractions become incredibly important when the total supply never changes. Now let's move to the second simulation. This is where things become much more interesting. Imagine a future where only 4 million Bitcoin are realistically available for purchase. At first glance, that sounds impossible. How could 17 million coins simply disappear? They don't disappear. They become unavailable. Think about a family home that's been passed down through 5 generations. Technically, someone could buy it. Realistically, the owners have no interest in selling. Bitcoin may eventually behave the same way. Long-term holders continue accumulating. Large corporations add Bitcoin to their balance sheets. Investment funds quietly absorb supply. National reserves begin treating Bitcoin as a strategic asset instead of a speculative investment. Every one of those buyers removes liquidity from the market. The coins still exist. They're simply no longer circulating. Imagine filling a swimming pool with water. Now picture thousands of people lowering buckets into the pool every single day. Very little water comes back. Eventually the pool isn't empty. It's just much harder to access. That's exactly how available Bitcoin supply can shrink without violating the 21 million limit. In this second simulation, owning approximately 0.015 Bitcoin suddenly becomes enough to place someone within an extremely limited ownership class. Think about that for a second. Not one Bitcoin, not half, not even 1/10, just over 1% of a Bitcoin. That's a completely different way of looking at wealth. Daniel remembered how he'd wasted years waiting for the perfect entry. He skipped buying during corrections because he wanted slightly lower prices. He hesitated during rallies because he thought Bitcoin was already too expensive. Meanwhile, institutions weren't trying to save a few $100s, they were simply accumulating. That difference in mindset became impossible to ignore. Retail investors often chase price, large investors chase supply, and history has shown that those two approaches produce very different outcomes. This brings us to something even more important than buying Bitcoin: keeping it. Because accumulating Bitcoin means nothing if you lose access to it. This is where thousands of investors unknowingly make one of the biggest mistakes of their financial lives. Many people assume buying Bitcoin through an exchange is enough. Others believe leaving everything inside an ETF eliminates all responsibility. Some never even consider what happens if an exchange freezes withdrawals during a crisis. Imagine buying physical gold. Would you leave every ounce sitting inside someone else's unlocked garage? Probably not. Yet millions of Bitcoin owners effectively do the digital equivalent every day. The strongest feature of Bitcoin isn't simply ownership, it's self-ownership. True Bitcoin allows you, not a bank, not an exchange, not a brokerage, to control your wealth directly. That's a revolutionary concept. But with that freedom comes responsibility. Daniel realized this shortly after purchasing his first meaningful amount of Bitcoin. At first, leaving everything on an exchange felt convenient. One password, one login, everything seemed secure. Then he started reading stories about exchange failures, frozen accounts, security breaches, and investors losing access to assets they believed were completely safe. That was the moment he ordered his first hardware wallet. Not because he expected disaster tomorrow, but because protecting wealth should happen before problems appear, not afterward. Think of it like buying insurance for your home. You don't wait until the house catches fire. You prepare beforehand. Bitcoin security works exactly the same way. A hardware wallet removes your private keys from constant internet exposure. Even more importantly, your recovery phrase becomes the true key to your financial future. That small collection of words may one day represent decades of accumulated wealth. Writing those words on a random piece of paper and forgetting where you placed it isn't a security strategy. It's a gamble. Imagine spending 20 years building wealth only to lose everything because of water damage, fire, theft, or one careless mistake. That's not a Bitcoin problem. That's a storage problem. The investors most likely to benefit from Bitcoin's long-term scarcity won't necessarily be the smartest traders. They'll be the people who accumulated patiently, protected their holdings responsibly, and simply refused to panic every time headlines screamed that Bitcoin was dead. Because if scarcity truly becomes Bitcoin's defining characteristic, owning even a small amount safely may prove far more valuable than constantly chasing the next market prediction. At this point, Daniel stopped asking the question almost everyone else was asking. He no longer cared whether Bitcoin would be worth $200,000 next year or $500,000 5 years from now. Instead, he asked himself something much more practical. If Bitcoin really becomes one of the world's most important financial assets, how much do I actually need before it becomes nearly impossible to accumulate? That single question completely changed his financial habits. Daniel was 35 years old. He earned about $72,000 a year. Nothing extraordinary. No massive inheritance, no lottery ticket, no six-figure trading account. Just an ordinary professional trying to build long-term financial security. He looked at his monthly spending and noticed something almost embarrassing. Streaming subscriptions he barely used. Takeout meals 3 or 4 nights every week. Coffee that somehow cost more than lunch. Random online shopping that he couldn't even remember a month later. Instead of trying to magically find thousands of dollars overnight, he made one simple decision. Every single week, no matter what Bitcoin's price was, he would buy a fixed dollar amount. Some weeks the market was green. Some weeks it was deep in the red. Some weeks the financial news claimed Bitcoin was the future. Other weeks the headlines confidently declared Bitcoin was finished forever. Daniel ignored all of it, because he finally understood something that most investors never do. Consistency beats perfect timing. Imagine trying to fill a bucket during a rainstorm. You don't stand outside complaining that one raindrop isn't enough. You keep collecting. Eventually the bucket fills itself. Bitcoin accumulation works exactly the same way. Now compare Daniel with his Uncle Robert. Every family has one. Uncle Robert watches 3 financial news channels every day. He predicts 10 market crashes every month. He proudly announces that Bitcoin is going back to zero. Then, 6 months later, he quietly asks everyone at dinner, "So, how do you actually buy Bitcoin?" By then, it's usually much more expensive than when he first dismissed it. The entire table pretends not to notice. Daniel simply smiles. Not because he's smarter, because he started earlier. Then there's another character you probably know. Let's call him Dave. Dave has been waiting for the perfect buying opportunity since Bitcoin traded under $20,000. When it reached $30,000, he said it was too expensive. At $50,000, he promised he'd buy after the next crash. At $80,000, he insisted he'd wait for a correction. Years passed. Dave became an expert at predicting lower prices, without actually owning any Bitcoin. Ironically, he spent more time watching Bitcoin than people who actually invested in it. Sound familiar? Here's the uncomfortable truth. Waiting feels safe. Doing nothing feels responsible. But history often rewards those who act thoughtfully while everyone else waits for certainty. Now let's explore the third and most aggressive simulation. Remember, this isn't presented as a guaranteed future. It's a thought experiment designed to stretch your understanding of scarcity. Imagine that over the next 20 years, the biggest corporations continue adding Bitcoin to their balance sheets. Governments begin treating Bitcoin as a strategic reserve alongside gold. Pension funds allocate a small percentage of their portfolios. Sovereign wealth funds quietly accumulate. Ultra-high net worth individuals continue transferring portions of their wealth into Bitcoin. And long-term holders simply refuse to sell. The result? Not fewer Bitcoin, just fewer Bitcoin available. Imagine walking into your local grocery store. Yesterday there were hundreds of loaves of bread on the shelves. Today there are only 10. Tomorrow there are 3. The bakery hasn't stopped making bread. People just keep buying faster than new supply arrives. Bitcoin is even more extreme, because unlike bread, new supply eventually stops forever. In this final simulation, only around 1 million Bitcoin remain realistically available for active purchase. If something like that ever happened, even an incredibly small amount, roughly 0.00375 Bitcoin, could become surprisingly significant. Think about that. Less than half of 1% of a Bitcoin, an amount many people dismiss today because it seems too small to matter. That's exactly how scarcity changes perception. History has shown this countless times. People ignored beachfront property before cities expanded. They overlooked internet domain names before businesses moved online. They laughed at digital companies before smartphones transformed daily life. Value often becomes obvious only after scarcity collides with demand. Bitcoin may be following the same pattern. No one knows exactly how the future will unfold. But everyone knows one fact that never changes. There will never be more than 21 million Bitcoin. Everything else is simply demand. So, what have we actually learned today? Not that Bitcoin is guaranteed to make anyone rich. Not that every prediction will come true, and certainly not that you need to own an entire Bitcoin to build meaningful wealth. The real lesson is much simpler. As Bitcoin adoption grows, the amount of Bitcoin required to stand out may become dramatically smaller than most people imagine. Scarcity changes everything. Price is only the symptom. Supply is the real story. Daniel understood that by the end of his journey. He stopped chasing headlines. He stopped trying to predict tomorrow's market. He stopped waiting for the perfect moment. Instead, he focused on 3 things he could actually control: accumulating consistently, protecting his Bitcoin through proper self-custody, and thinking in decades instead of days. Because while millions of people remain distracted by short-term price swings, the biggest players continue competing for the same permanently limited supply. The question is no longer whether Bitcoin is scarce. The question is whether you'll secure your share before scarcity becomes impossible to ignore. If this video challenged the way you think about Bitcoin, let me know in the comments. Which of the 3 simulations do you believe is the most realistic? The conservative scenario, the institutional adoption scenario, or the ultra-scarcity scenario? I'd genuinely love to hear your perspective. If you enjoyed today's breakdown, don't forget to leave a like and subscribe for more deep dives into Bitcoin, macroeconomics, and the future of money. Because the biggest opportunities often appear long before they become obvious. And in our next video, we'll explore something just as fascinating. We'll uncover why the world's largest financial institutions are quietly changing their Bitcoin strategies, and what that could mean for ordinary investors before the next major wave of adoption begins. Trust me, you won't want to miss that one.